Module 5 was about American options. On the test, we'll focus on the following parts. First, the very basics. You need to understand the basic facts about American option. What is an American option? What happens if I early exercise? And what are the implications of that? Then, of course, the right to exercise early has a value implication. You need to understand the relationship, the value relationship between European options and American options. And then you will need to be able to decide when to early exercise, and we learned that is a cost-benefit analysis. We will do this especially on stock options and a little bit on FX options. Very important, never forget the relationship between European options and American options. An American option is nothing else than a European option plus a feature. This feature is the feature to early exercise. That means everything we learned about European options is also true about American options, except they have a bit more value because they offer a bit more flexibility. The very basic facts. Very important to understand what happens when I early exercise. Here we have a call option, American call option. We know that if I exercise the call option, I change the position from a call into a long position in the underlying. And it seems as if we are giving away a put. So early exercise has a cost. We can think of this cost as for a call, for an American call, to give away a put. In the same way, if we have a put, if we exercise an American put, we go short the underlying, and this looks as if we give away a call with the same strike. Since early exercising means giving away an option, there is a cost associated to early exercising. Hence, I would only exercise early if the option is deep in the money, and thus this has another implication, namely that early exercising doesn't change the delta of the option very much. Actually, it's like you take the same exposure in a different way. First, you have the exposure to the underlying with say a deep in the money call, and afterwards you are long the underlying. That doesn't usually change the delta. And we actually have seen just right before you early exercise, the delta of an American option is 100%. Also, always remember that the minimum value of an American option is parity to spot. If the American option trades for less than parity to spot, I can buy the option, immediately exercise, extract the parity to spot, and thus make an arbitrage. But an American option is also a European option plus. So in a certain way, an American option has two minimum values. First, an American option is at least parity to spot, so the value is at least parity to spot, and then also the American option is worth more than the European option. Remember that then we did some cost and benefit analysis of early exercising, and we concluded that, for example, if I have a stock option, if I have a call on a share, I would only exercise early this call just a day before the dividend, before ex-dividend day. And if I have a put gets typically exercised on the dividend day or long before the dividend day, actually the ex-dividend day. Good. I think we best look at an example. An example is usually showing these things best. Now the example is the following. It's quite a nice example. So let's assume we have a share. So a stock option, we have a share trading at 50. We have a dividend. The dividend is expected to be $2. And it's a very no special setting. So the stock loan fee is 0, we assume that it doesn't cost money to borrow the share. The interest rate on the US dollar is 4% per annum. Now we have a call option. We have a 45 strike call option, and this is now an American call option. The option trades for 5.42. We also see that the European equivalent trades for $4.10. Timing-wise, we have 90 days to expiry, and we have 60 days to ex-dividend date. And now the question. The question is, the company unexpectedly announces that it would double the dividend payment to $4 this year. The share price does not move on that announcement. Questions: which two of the following four statements are correct? A. The value of the American call increases when the dividend gets suddenly doubled, or the value of the European call decreases, or the value difference between the American call and European call increases, or the value difference between the American call and the European call decreases. Okay, I think I read this wrongly, so let's see again. Question: does the value of the American option, the call option, go up? Does the value of the European call option go up when the dividend gets suddenly expected to be higher? And then what happens to the difference between the American option and the European option? You see that at the moment the difference is about $1.30. Now, usually if you see a question like that, you're a little bit puzzled, and the same happens to me. So we have to carefully analyze the situation. First, forget about the dividend that is now announced to be $4. Let's first look at the situation that this is described here. These values, they were all under the assumption that the dividend is $2. Now, in this setting, if the dividend is still $2, interest rates are 4%, my question: is the option an early exercise now? Is the option an early exercise later, a potential early exercise later, or actually what is the situation? First, always look at the strike price. The strike price is 45 here. The share price is 50. That means the parity to spot is 5. We can see that the American option trades for 5.42, so it trades 42 cents above parity to spot. Now let's look at the 45 strike call, but the European version. This one only trades at $4.10. So this actually trades below parity to spot. Can this be? Of course this can be. European option doesn't care about parity to spot. A European option more focuses on parity value, that means the parity to the forward. Maybe it makes sense to briefly look at the forward. Where does the forward trade? Spot is 50, interest rates are 4%, the period is 90 days, so the carry costs are about 50 cents. I have a dividend of 2, that means the forward should be around 48.50. The parity to the forward, therefore, of the European option is 3.50. That means the parity value of the European option, remember interest rates are 4% a quarter of a year, so the parity value is also about 3.50, maybe a little bit less, maybe 3.46 or so. That means the volatility value of the European call is only about 65 cents. Okay, that is the situation. Option quite deep in the money, etc. The American option trades for 5.42, so it trades above parity to spot. And now let me go to the next slide. I summarized some facts on the next slide. First, is the call an early exercise today? We know it's not a call early exercise today. Why? Because there's no benefit of exercising today. I better wait for a while, because all the benefits, what are the benefits here of early exercising? The benefits are the dividends. But the dividend, if I early exercise, I get the dividend. If I don't early exercise, if I wait until expiry, I don't get the dividend. So the benefit of early exercising is the dividend, but I get this dividend even if I exercise tomorrow or after tomorrow. So therefore, the benefits do not change, but of course the cost of early exercising change. If I exercise today, my costs are higher because I have to fund the strike price for a longer time. Remember, when I early exercise, I have to pay out the strike price. And that is a time value of money. So I best wait just until the day before ex-dividend day and then exercise my option. So the call is certainly not an early exercise today. But is the call in general a candidate for early exercise? Let's maybe briefly make the calculations. So the benefits the benefits of early exercising is the dividend. The dividend in that situation is $2. So I get $2. What are the costs of early exercising? I have two costs of early exercising. First, funding the strike price for 30 days at 4%. That means funding $45 for 30 days at 4%. That's a low amount. I got 17 cents or a little bit less. And then I give away the put, the 45 strike put. But remember, we just calculated that before on the previous slide. We calculated that the value of the 45 strike put is just about 65 cents. Why do I know that? Because the European 45 strike call has a volatility value of about 65 cents. That's the value of the put. So all in all, my benefits, the two benefits of the dividend, is much, much higher than the costs I have of early exercising. So this is an early exercising candidate. So if I had to do the decision today, either to early exercise or to never exercise before expiry, I would early exercise today. But of course I can wait. So therefore, it's not an early exercise today, but it's very likely an early exercise before expiry. Clearly, this must be the case because we can see it in the value. In the market, this trades, let me go back where it trades. In the market, it trades, the American call trades for 5.42. That means 42 cents above parity and quite a bit above the European. So therefore, I have to pay 130 more than for the European option, and that 130, that is for the right to early exercise. It seems this right to early exercise has quite a bit of value. Now, that was not the question. The question here was, what happens if the dividend increases? Now, there happened something slightly counterintuitive. First, let's look at the European option. The European option is very simple what happens to the European option. If the dividend gets increased to $4, that means $2 more than when the prices were taken before. An increase in the dividend means that the forward decreases. The forward will decrease by about 2. That means the parity value of the European call will decrease by about 2, and that means that European option will lose in value about 2. So the European option will lose in value quite a bit. Let me get back to the point. So the value of the European option will decrease by about $2. Now, what happens to the American option? The first intuition that we usually have is saying, hey, the value of the American option will go up. And we say that because, oh, now the dividend is worth more. So it's actually quite cool that much better actually, that I have the American option and not the European option. But the value of the American option will actually not go up. Why? Now that the dividend is even higher, the option was even a likely early exercise candidate when the dividend was 2. But now that the dividend is 4, it's even more likely that I early exercise. So now it's quite a fact, not 100% a fact, but very, very, very likely that I exercise the option just before ex-dividend date. That means the life expectancy of the option goes down a bit. Now, the life of the option most likely ends on ex-dividend date. Since the life expectancy is shorter, the value of the American option moves a little bit more to parity to spot. So my fact here, or my point here is the American option will barely change in value. Actually, it will most likely go down a little bit, but we know that it can never go down more than 2. So the minimum value will be parity to spot. That means $5. So the value of the American option will fall a little bit, but the value of the European option will fall quite a bit. And so let me go back to our list of potential answers. The value of the American call increases. That's not the case. But even if you were not sure about that, you see here we clearly give you how many answers are correct. So 2 out of the 4 statements are correct. Even if you have a question mark here, whether the value goes up or down, even if just a little bit, this goes up a little bit or down a little bit, let's put a question mark here. Then what is certainly true, the value of the European call decreases. This has nothing to do with American options. This is just what we learned about European options. The dividend goes up, the forward goes down, hence the value of the European option decreases. And it decreases by roughly the amount of the dividend. And then I have 2 other questions, or 2 other possible answers. The value difference between the American call and European call increases. This is certainly correct. So the second one is certainly correct, and the third one is certainly correct. Why? Because the value of the European call goes down a lot, and the value of the American call can never go down more than 42 cents. So it doesn't go down a lot. Hence, the difference increases. So even if you think the American option will go up a little bit, that is still correct. So this is correct, and this is correct. And now your intuition is actually correct again, because we thought, oh, now the American call is certainly worth more. Yes, it's certainly worth more than the European call. And it's not on an absolute level, the American call doesn't increase, but on a relative level, relative to the European, it increases a lot, because now you can you can harvest the dividend of 4, and this is quite a bit. 4 is a lot of money, while if you have the European call, you cannot harvest that. So let me say it again. This one is correct, number 2 and number 3. And here are the answers why. Now, of course, we could change this question slightly and give it a different slant. So let's assume we are in exactly the same situation. What is the situation? Let me go back. This was the situation as before. Underlying trades at 50, dividend is 2, interest rates 4%, 90 days to expiry, 60 days to ex-dividend date. The American 45 strike call trades at 5.42 and European 45 call trades for $4.10. And now assume that the dividend does not change, so the dividend the dividend stays at $2, but now volatility increases. So what happens to the American call, the European call, and the difference between the American and the European call if volatility increases? Now, think about that for a sec. What happens to the value of the European call if volatility increases? Of course, the value will increase. What happens to the American call if volatility increases? Of course, the American call value will also increase. I mean, options like volatility. But now, think about the difference between the European option and the American option. So by the fact that volatility is going up, does the American option become more European or less European? And the fact is, exercising the option will become less likely if the volatility increases. So actually, the American option will behave more like a European option if the volatility increases. And then we think, why would this be the case? But this is actually very simple. Remember our very first key point. We said when you have an American option and you exercise the American option, then you're giving away another option. So for example, if we exercise an American call, we can think of that as giving away a put. So the cost of the American call, the cost of exercising the American call, so the cost of exercising will be that we lose the downside protection, the out of the money downside protection. We lose the 45 put. That put we lose has a value. If volatility is higher, this put we are giving away has an even higher value. So the more uncertain the world, the more preferable it is to stay in the option. Hence, in high volatility environments, American options behave more like European options, and it gets less likely that you exercise them. Good, so the value of the American option will move closer to the value of the European. Let me summarize. Volatility goes up. Of course, the value of the European option goes up. Volatility goes up. Of course, the value of the American call will increase. But the difference between the American call and the European call will decrease because exercising means giving away optionality, and this optionality you're giving away has more value when volatility is high. So quite a nice result, and we get it very, very cheap. Now let me make an analogy. I would like to to summarize a bit what I said. Here you have the value of the American option. And the value of the American option has like two minimum values. One minimum value is the value of a European option, and the other minimum value is the parity to spot. So the American option can never be less than either parity to spot, and it cannot be less than the value of the European option. So the value of the American option has to be above these two. And how exactly these two are, sometimes the value of the European is higher than parity spot, and sometimes it's the other way around. I ordered this to the same situation we had just before. Now, value of the European option. The value of the American option equals the value of the European option if we know that the option will never be an early exercise. The American option will be parity to spot if we know that it's an early exercise today. So now you can think in the following way. If the likelihood of early exercise increases, that means the life expectancy of the option gets shorter, then the value of the American option moves closer to the parity to spot. That's what we had before, right? That's what we had in the very first case when the dividend changed from $2 to $4. But then, if the likelihood of early exercising decreases, then the value of the American option moves closer to the value of the European option, right? And you remember when we said volatility goes up means this option jumps up and this option jumps up as well. But now they are much closer to each other. So I think this is quite a nice analogy how you can keep in mind and visualize what's happening to the value of the European and the American options. Let me, as a last little hint about American options, let's look at a currency option. So here's an FX option. We have a 100 strike American call on the currency pair US dollar yen. So yeah, exactly. So that means you have, let's say it's called, you have the right to buy a US dollar for 100 yen. And that's the option. The right to buy dollars for 100 yen. And I have here a graphical representation. So I have here 4 lines. You see the dark gray line. I did this with the model we built together in the module 5, right? So here the gray kinked line, that's parity to spot. You see it kinks at 100, that must be parity to spot. And then the light gray line is parity to forward. Now, we are usually, in most of the examples we had, the parity to forward line. So the parity value line, so the zero volatility line of the European option, if you want, so was on the left side. But you can see here we have US dollar yen. So yen interest rates very low, US dollar interest rates higher. So benefits are higher, costs are lower. So here the carry rate is negative. That's why the kink of the parity value line for the European option is above 100, is on the right to 100. And now we have 2 lines, right? We have the red line. The red line is the American call. And we have the yellow line. The yellow line is the European call. And you see this here, these 2 effects I explained before. You see these quite nicely. First, look at the currency pair again. US dollar, yen. US dollar interest rates higher, yen interest rates usually extremely low. Now, if you think about this option, you have the 100 strike American call. What happens if you exercise the American call? If you exercise the American call, you jump into from the option position into a position in US dollars, right? And you get long US dollars if you exercise. Is it good to be long US dollars? Yes. Why? Because the US dollar interest rates are higher than the yen interest rates. Let me say this again. If you exercise the 100 strike American call, then you go long dollars and you go short yen. That means you earn dollar interest rates and you pay yen interest rates. So here, early exercising is beneficial if the option is deep in the money. And you see here on this right side, here's deep in the money. And deep in the money, here you can see that the value of the American call is higher than the value of the European call, and you see quite clearly, actually, the value is parity to spot, right? It is exactly on this parity to spot line if we are deep in the money. On the other hand, the European call is worth less than parity to spot because it converges to the parity value line, so the parity to the present value of the parity to the forward. And the parity to forward is smaller because the forward is smaller because the US dollar interest rates are higher, right? So you see it quite clearly here. But if you are very much out of the money, then the option is very unlikely to be an early exercise because, of course, it makes only sense to early exercise if we are on the right of the strike. So here the value of the American and European are the same. Now let's switch to the put. Here the American put, same strike. You see here the same lines. This is the put, this is the strike, so this is the parity to spot. This is again the parity to forward. But now look at the option. The option is a put on the currency pair, US dollar, yen. So if you exercise the option, you go short dollars and long yen. So you pay dollar interest rates and you gain yen interest rates. So actually there is just costs. Exercising this option is just costs. You have higher carry costs because you have to pay US dollar interest rates and just get yen interest rates, and you give away the optionality, right? So you lose protection and you have a position that is more expensive to carry. So this one, you would never exercise this one. Since you would never exercise this one, the value of the American and the European is exactly the same. So here, the value of the American is the value of the European. So I think this summarizes quite nicely what we have learned in this module. Also remember, we did some other stuff in this module. For example, we spent quite a bit of time in creating our own model. We needed to do that because we couldn't use Black-Scholes, and we needed to adapt the binomial model so that we can talk about values. But this is not a focus on the test. And then also, we had a part American versus European. We reviewed part of this just before. This had to do with stock options, with American stock options, with dividends and these things. But then there was a second part, which was conversion trades with American options. And that's also not a focus on the test. But I hope that when you spend time with American options, at least that's how I feel it. If we spend time with American options, we also learn to understand the European options better.